In this presentation, we will continue entering personal cash outflows from our bank statement into QuickBooks, including mortgage payments, medical cost payments, and IRA payments. For more accounting information and accounting courses, visit our website at accountinginstruction.info. Here we are in QuickBooks. We currently have the open windows open. In order to open the open windows, you want to go to the View dropdown and select the Open Windows list. We're going to go to the Banking dropdown and go to the Use Register, where we will be entering our transactions as we have in the past. We're going to say OK for the checking account. And now we're going to take a look at our bank statement. Here is our bank statement. We've been entering this data in from the bank statement into our personal records. We're just going to continue doing so for the costs. We're down in the final stretch here. We're going to be entering these items into the bank statement. These are going to be outflows. They're not going to be checks. We're going to say they're all electronic transfers. Starting off with Office Depot. Now, the reason Office Depot, we made it blue here is because we're saying that there's going to be some overlap. We have a business account, a QuickBooks account, and a personal QuickBooks account. What happens if we paid something business related from the personal account? That's what we're going to say here. We're going to say, oh wait, this Office Depot account that we paid from the wrong account. It should have gone out of our business checking account. How can we deal with that? How can we account for that? Let's go back to our checking account. We're going to go into our checking account, and that happened on the 25th. So I'm just hitting the plus arrow to get to 1/25, 2020. It's going to be an E for an electronic transfer, and it's going to be Office Depot, which we don't have yet. So I'm going to type in Office Depot as the vendor and then select Tab and Quick Add. It's going to be a vendor that we're going to have, 370. Now again, this went to it should have been a business related expense. We bought it from our personal account from the business or for the business. So what we want is a loan account. We want to go back up. It's not going to be an expense on the personal books. It's going to be something that the business owes us money for. So we're going to go up here to due from business. We're going to say, hey, this is something we paid for from our personal account that's owed to us from the business. So we're going to say it's going to be that asset type account that we set up in the same thing as if we made a cash payment to the business as we did prior, where we transferred money to the business checking account. That's what should have happened. We should have taken money out and then paid for it out of the business checking account if we wanted to make that transfer. But that didn't happen. We skipped a step. We just paid for something business related directly out of the personal account. And therefore, we're just going to record it as a loan from the business. We loaned money to the business by purchasing something for it. And from the business account, they're going to owe it back to us now. So we're going to record that. And let's take a look at what that looks like on the balance sheet by going to the reports, going to the company and financial, and scrolling down to the balance sheet standard. Changing the dates, and the date range is up top, from 01/01/20 to 12/31/20, and OK. So now we're going to have this due from business is 2030. What we're going to need to do is reconcile that with what's on the business account, because they should match. So the expense that we had for this 230, if I double click on it, that 370, the 230, the 370 is for Office Depot. That's not in the business records, and so we're going to have to add it to the business records as an expense because it should be an expense on the business books. So this reconciliation, this ability for us to basically tie out what we have here to what's on the business records is going to help us to separate the two and make sure we record everything in the proper expense account with this to QuickBooks account method. So I'm going to close this back out. We're going to go back to our checking account and see what else we have. So let's highlight this. We found the Office Depot, done and done. Mortgage payment. So we're going to say this is the bank for the mortgage. So we're going to go back to QuickBooks and say, okay, we made a payment on the 25th. That's going to be E, and I'm just going to call it, this is a generic name again, but bank mortgage payment that we have. Now the mortgage payment is often a bit confusing for people. I'm going to set that up. I'm going to say quick add with vendor and OK. And that's going to be for 2300. The mortgage payment's a little bit confusing most of the time because the mortgage payment is paying off a loan. And we know that a loan, if we were to record this properly, is going to be recording both the principal reduction and the interest. And to do that, we would need an amortization table. For a lot of people, that's too much to deal with on their statements. And what they really want, what they're trying to do is more of a cash basis statement because they want to know on the income statement usually to get a quick idea of what their payments are from a month-to-month standpoint. So I'm going to do what's, again, not proper from an accrual standpoint, but proper from a cash basis standpoint now. And we may go back to it later and discuss some other options for it. And that is to just record it as a mortgage expense. And what that'll do is it'll allow us to budget on the income statement on a cash basis, but isn't correct from an accrual basis because we're not allocating between loan and interest. So we'll discuss more of that later. But again, I think a lot of people would be fine to enter this as mortgage interest. Also note that it's not something you really need to track just for tax purposes because you're usually going to get a form from the bank, a 1098, that will tell you the mortgage interest that needs to be deducted. So we want to do it oftentimes from the personal side for a budgeting purpose. And that means the profit and loss is what most people look at for budgeting, and so having it on a cash basis is often useful. So I'm going to put in an expense here, and we'll just type it in as mortgage expense, and tab, and set that up. It's going to be an expense account, OK, and enter. So there we have that. We're going to go back to our report and say, okay, we've got the mortgage payment, highlight it. Then we have the Blue Cross. This is going to be our health insurance. We're going to say this is our health insurance. So we're going to go back over here and say Blue Cross on the 26th. Electronic payment, Blue Cross, new vendor, tab, quickly set it up. And it's going to be a vendor, okay. And we're going to say that that was for $500. Now we could put this into medical as well, or we might want to break out the insurance. And that's what I would typically do. So we're going to make a new account saying this is medical, but I want to see the insurance payments separately. So I'm going to make the account called insurance-medical because I might have other insurance, might have life insurance, might have some other types of insurance, auto insurance and whatnot. So I'm going to make this insurance/medical insurance, tab, and set that up. And there we have it. That looks good. Okay. And now also note that this medical insurance might be for more than just 1 month. It might be for a year or 6 months or a quarter. And if that's the case, again, on a accrual method, we're not doing it perfectly accrual based here. But for most people on a cash basis, they're not going to want to do an adjusting entry at the end of the time period. We could in the same format we do for business, and we should really if we want to be able to allocate these expenses properly, so that we can make better decisions. But most people are probably going to be on an accrual basis with insurance. I mean, they're going to be on a cash basis with insurance. So they're probably going to want to record it just when they pay for it. So we'll enter that information and say yes. And next one we have, so we've got the medical insurance. Now we've got the doctor. So we went to the doctor and have a doctor bill. So we'll go back to QuickBooks. That happened on the 26th. We're going to say E. And then it's Dr. E. That's their doctor's name. Easy to remember. That's why we like that doctor. So $195. And we're going to say that this was, and again, this could go into a medical costs, or we might want to say a separate category for the doctor visits, or maybe separate doctor and prescription drugs. I'm going to put it into an account called medical costs. And I'm going to put the drugs in there, the prescription drugs, and the doctor visits. Again, that's just a preference. We could break those out. We could put the insurance in with the medical costs or break that out. It just depends on how we want to see it. I typically think insurance would be nice to have broken out. Medical costs, I'll put all grouped into one place, including doctor visits and the prescription drugs. But depending on your bills, if you have a lot of prescription drugs, you may want to break them out separately because they could be significant and something worth tracking in a different account. So we'll say tab and set that up. Okay, save and close. Next item we have will be the Rite Aid drugstore. So that's going to be the prescription drugs that we're going to say we have. And so that's going to be the 26th, and E, and I'm going to say Rite Aid Drug Store. Tab, quickly add it, quick add, vendor, $37. And this one I'm just going to type in. I mean, we could hit the drop down and find medical costs, or type it in there. Next month it'll pop up and show up automatically. And that's going to be it, medical costs. Next item, crossing out the medical costs, we have, or highlighting them, Edison Electric. So that's going to be our utility bill, or our electric bill. So 28, I'm going to say E, we paid for Edison Electric Company. Edison, I think that's right. Tab. And we'll quickly add that. Vendor. And that's going to be for the $34. And this is a new one. Now we might want to put it into just Edison. We could just name it Edison. That would work. But it's probably, or electric bill, because we might move and might call it electric bill somewhere else or something, because maybe it's not Edison anymore. Or most people probably just put it into utilities. So most people, utilities used to be kind of like the default for telephone and the Edison and the gas and the electric and whatnot. But now oftentimes they're broken out. The telephone clearly has its own account oftentimes because it's significant, as does the Edison account. So utilities kind of only means electric a lot of times now, although it could be electric and gas if we have those two into the utilities. So I'll keep it utilities. If you called it the electric bill, or even if you called it Edison, personal account, probably be fine. So you would be fine. Not probably. Tab, set it up, save and close, and okay. Next item, we've got auto insurance. Auto insurance. So let's go back over here, and we're going to say that was on the 28th. E, and we're going to say, now again, this is a generic name, auto insurance. We'd obviously have an insurance company that we'd have AAA insurance or something like that. But we're going to say auto insurance, set it up, vendor. That's going to be for 1200. And I'm going to put this, now I could put this into just auto expense, but I'd rather break out the insurance. So I'm going to put it into insurance again, but I'm going to change the name, insurance, and then put it into auto. So I'll put it into a separate auto so I can separate my insurance from my gas payment that I'm making, or other types of areas for the insurance. Now notice you might want to put the insurance, like the way I grouped it, it's going to list my insurance here because it's in alphabetical order. I might want to emphasize the auto payments and say auto/insurance, emphasizing the auto part of it and not the insurance part. Preference on the two. Okay, so also note that this 1,200 may not be for 1 month. That might be for an entire year of auto insurance. And so most people will probably remain on a cash basis for their personal records. But just note that it's really going to distort January. January is going to look like we paid a lot of money, when really we didn't. We paid for an entire year's worth of auto insurance, which we're not going to have to pay for in February. So most people aren't going to want to do an adjusting entry at the end of the month to properly allocate the expenses over 12 months. But to really make the months fair and see what we actually did, that's what we would need to do. So as you look at the financial statements, just realize that when you think about something of auto insurance, we might go into an adjusting entry at the end just to show what that process would have to look like. It would take more work to step away from a cash basis to an adjusting entry at the end of the time period. So we'll enter that. New account, and okay. Next item, it's going to be the gas company. So I'm going to highlight this. We're going to say gas company. Now this isn't our car. We're going to say this is the gas company for the home. So we're going to say E and this gas company. We're going to quickly add that and set up the vendor, and it's going to be for $26. Now again, we could put another company, we could say gas company and select and track the gas separate. Many people may want to do that. But typically gas and electric oftentimes are the two that get lumped up into utilities. So, and since gas is usually smaller depending on where we are, we might want to do that. So either method, whatever you think is best. Do you want to break out the gas and the electric, or do you want to group them both together in utilities? I'm going to group them together, utilities. No convention is set in stone here because this is the personal account. So they're less set in stone even than on the business side. They're not set in stone on the business side either. So here we have that account. I'm going to record and say yes. Next item. And now we've got an IRA. So we put money into an IRA. All right, so we're going to go back over here. That's on the 29th. And electronic. And we're going to put E-Trade is going to be like, so the IRA is an individual retirement account. And typically people put money into an IRA to save money on taxes. But the IRA itself is just an investment, usually in mutual funds or stocks and bonds. So E-Trade would just be a place that you can buy stocks and bonds under the umbrella of an IRA so that you can get a deduction for it. So in other words, this is really just an investment in retirement plans. It's stocks and bonds. All we're doing is buying stocks and bonds. We put it under the umbrella of an individual retirement account because we get tax savings at the point in time we put it into that account. So I'm going to set tab, quick setup. That's going to be 1,000. So what are we going to do with that on our investments? Well, on our financials, it shouldn't be an expense really. We could put it in as an expense, but really it's an investment. We took money out of the checking account and we put it into like stocks and bonds that was under the IRA. So what we should do is set up an asset account here. So that's what we're going to do here. I'm just going to call it E-Trade and an IRA because that'll be the easiest thing for me to just see it. Now when we set it up, we're going to set it up as an asset type account. So it's not going to be an expense. We're going to change this from an expense to an asset type account. And since it's an IRA, that means we shouldn't take it out until we retire. So it's a retirement account. So we're not going to take it out. We shouldn't. So we're not going to put it into current assets because they're not liquid, supposedly, because we're keeping them in there for a long time. So I'm going to put it into other current assets and try to say, hey, this is outside of what I should be taking out. And so I'm going to put it into long-term assets. So let's say save and close. Now this is a bit unusual. I'm going to enter this transaction because all of the things we've done so far is on a cash basis. And now we're tracking balance sheet items, which we haven't really done to track the balance sheet items. But let's take a look at this one as to why we might do that. And then we'll go back to IRAs later when we talk more about the balance sheet and how we can track it. So if we go to the reports up top, company and financial, and look at the balance sheet standard. Actually, it's already open over here. Let's just go to the open windows where we have it open. And then if we scroll down, here's an IRA. So we just put it in there as other current assets. It's not grouped up here with the cash and the other current assets. It's down here as the other assets or non-current. And so that's going to help us to keep it separate from the more liquid assets, the assets we can more easily take out and use. And so we'll put it down here. Now note, we might have more money in the IRA that we had in there before. We might have a 401k plan. What about the home and all this other stuff that we have that's not on the books? Well, we'll talk more about that. We could talk more about that later on how we could add some of our other assets, how we can work on the balance sheet and tracking things like retirement accounts, like 401k accounts. Right now, we're focusing in on the activity during the time period, the performance type stuff, generally income statements type stuff, by looking at activity statements, including the bank statement, in order to enter that detail into the system. So for this, however, we can't really avoid it because it's a cash basis item. We could have put an expense on it, but it would be more proper to put it in as an asset. It's not really an expense. We had that same issue here with the due from business. We had to put it up here, otherwise it would kind of distort things. So even though we're just doing on a cash basis, there's a few things that we kind of had to deviate, work with the balance sheet accounts rather than being like a pure cash basis system. And then we'll go back and discuss more of the balance sheet later. So let's go back to the checking account and see, we got one more, I think, one more item. So we're going to right click and highlight that. The next one is state tax, property taxes. So let's go back over here. We're going to say that happened on the 31st. And we're going to say that's an E, and we're going to say it's state tax. And we'll call it property tax. Now, of course, the vendor would typically be like the county or the state tax collector or something like that of the county we're in. And it would be property tax, I'm thinking, on the home, on our house. And so that would be for $346. And then we're going to set up an account. Now, again, we could just put it into taxes, general taxes, to other taxes other than the income tax. We don't want to put it into income tax because we'd probably want to track something like that differently. So we could put it into a generic, state tax calculation item. I'm going to put it into an account called property tax because property tax is one of those areas that we might need to track for our income taxes at the end of the year. So we might need it. They might be tracked somewhere else, but we might need to track it. Other state taxes might need to be tracked as well for the same reason. But property taxes, usually significant, something worth oftentimes breaking out into its own expense category. So I'm going to say property tax, tab, set it up, expense, that's what we need. Okay, there we have it. So that's the last one. If we go back to our balance sheet then, this is what we have so far. Most of the items just coming out of our checking account. Here's all the information if we double click on the checking account and closing that back out. Then we had a few items we had to deal with for the balance sheet accounts rather than the other side being income statement account or profit and loss accounts, which is on reports, drop down, company and financial, profit and loss. Changing the date range from 01/01/20 to 12/31/20. We then have our income and then all of our expenses that we have been entering here. Here's the medical insurance. Here's the other medical costs that we have, and the utilities that we've entered information into, and the property taxes. So we now have a list, and hopefully this is a pretty good idea of the types of stuff that we do from month to month, so that we can get a comparison and say, what, is there anything we can do to budget here, or what can we spend more or less money on based on this information. For more accounting information and accounting courses, visit our website at accountinginstruction.info.